Bitcoin's price has fallen once again as the sell-off in the global cryptocurrency market continues. The crypto investors are still reeling from the effects of the dramatic market crash that led to Bitcoin's ultimate downfall below the $20,000 level. But Bitcoin is not the only digital asset suffering from this crash, as many other altcoins, including Ethereum, Solana, Cardano, and others also crashed brutally. Hello and welcome to Smart Tech Ideas. In today's video, we will decode the shocking crypto crash of June 2022, key factors that triggered this event, why some metrics suggest that this crash is not over yet, and how low will Bitcoin prices go before recovering. Make sure to stick around till the end of this video, where we will discuss the possibility of Bitcoin market bottoming out and the chances of a bounce back in second half of 2022. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. So without wasting any time, let's dive right into the video. After momentarily approaching $20,000, Bitcoin is back above $21,000, with the total crypto market capitalization surpassing $900 billion. While many analysts assumed that Wednesday's low may represent the cycle's bottom, others caution that further volatility may be on the horizon. This week, major platforms including Celsius and Binance encountered operational challenges, which they attributed to a surge of investors selling assets. Additionally, Bitcoin is at a level not seen since the second half of 2020. The digital currency has declined by more than 70% since its all-time high in November, falling by more than 20% just the past week. Bitcoin has a strong correlation with stock market indexes, especially the Nasdaq, which climbed on Wednesday after the U.S. Federal Reserve raised interest rates by 0.75 percentage points. However, the Nasdaq plummeted more than 3% on Thursday. A lot of concerns weigh on the cryptocurrency industry. After the fall of the popular stablecoin Terra USD and its sister token Luna, sentiment is rattled. Stablecoins are a sort of cryptocurrency that are designed to be linked to a real-world asset. Many appear to be pegged to the US dollar at parity. Some cryptocurrencies, such Tether and USD Coin, are backed by actual assets such as paper currencies and government bonds. However, several algorithmic stablecoins, such as Terra USD, lack reserves. The $1 peg is instead managed by an algorithm. The present bear market, which is frequently referred to as a new crypto winter, also tests the resilience of other ventures. This week, another algorithmic stablecoin, USDD2, lost its dollar peg. Tron DAO Reserve, which is responsible for preserving USDD $1 peg, maintains a reserve of other cryptocurrencies, including Tether and USDC. In the meantime, all eyes are on Celsius, the cryptocurrency lending platform that may be facing collapse, triggering fears of market-wide contagion. This past week, Celsius halted customer withdrawals. Similarly, Solana and Doge, which made the largest gains throughout the rally by climbing up to 16%, returned to the levels they held prior to Powell's remarks. The identical situation transpired during the Fed's previous meeting in May during Powell's post-meeting news conference, in which he described the rate hike. Both stocks and cryptocurrencies rose. The reality check arrived the following day. In recent days, Bitcoin came close to reaching $20,000, a threshold that might potentially prompt significant liquidations. However, given the lack of bullish sentiment and deteriorating liquidity, it is unlikely that the market has yet reached its bottom. As a result of the rate hike, we will observe a decline in the yield of all crypto assets. Borrowing has been crucial for all market participants, whether they are traders attempting to profit from contango or market makers attempting to arbitrage across exchanges. In contango, the futures price of a commodity exceeds its spot price. In light of the current deterioration of contango and the narrowing of the spread on the cryptocurrency market, institutions have less incentive to execute these strategies and hence have less need to borrow. All of the aforementioned factors combined with the general market scenario will compel high-yield suppliers to drastically reduce their interest rates. Kevin O'Leary, a billionaire investor and Shark Tank host, stated Thursday on CoinDesk TV, First Mover, that the cryptocurrency market has not yet reached its bottom, but capitulation is necessary and a good thing before a longer-term rally can occur. The term capitulation refers to the dramatic increase in selling pressure in a sinking market or securities that signifies a widespread investor surrender. Bitcoin's proximity to $20,000 is causing concern on the market, but after narrowly avoided breaking support, has the worst actually passed? Multiple on-chain signs suggest that the cycle's maximum misery has not yet arrived. This week, the stakes are high for many hodlers, as over half of the supply is being held at a loss and miners are increasing BTC shipments to exchanges. Even some of Bitcoin's largest investors, including MicroStrategy, are forced to defend their belief in Bitcoin in the face of falling prices. With objectives as low as $11,000, let's examine how much further the market must technically fall to match prior bottom zones. Despite the decline to 18-month lows, Bitcoin's priced action has yet to shake out all of its speculators. According to the various on-chain analyses, there should be an upcoming increase in capitulation. This is due to the fact that at macro-priced bottoms, the ratio of short-term to long-term holders has historically favored the latter. It calculates the ratio between the 1-week and 1-2-year cohorts of the realized cap hodl waves metric, which divides coins by when they last moved based on their weighted realized price. Once the indicator enters the green zone, it indicates that capitulation has reached its height and that a price floor is approaching or has already been established. It may appear as if the entire Bitcoin market is in the red, but over $20,000, many investors continue to hang on to what are likely to be tiny gains in the hopes of a rebound. Before it can be considered surrender, at least 60% of the supply must cause unrealized losses, as was the case in March 2020, late 2018 and previously. Despite the fact that their production costs are likely closer to $30,000 than $20,000, Bitcoin miners have yet to begin offsetting expenses with Bitcoin sales. However, coins are migrating to exchanges at the fastest rate in 7 months. As a result, the Bitcoin network hash rate has not yet experienced a precipitous decline, as is typical during periods of intense price pressure. Charles Edwards, CEO of asset manager Capriol, developed the hash ribbon statistic to confirm the lack of trend. Hash ribbons utilize the 30-day and 60-day moving averages of the hash rate to determine when miner capitulation occurs. Once the 30-day moving average rises above the 60-day moving average, it can be concluded that the worst has passed and miners can return to work. This has not yet occurred, and based on previous occurrences, this could portend a time of maximum suffering. In the preceding 2 months, crypto markets have experienced significant corrections. As of present, the worldwide cryptocurrency market capitalization has decreased to $949 billion from a peak of $3 trillion in November 2021. Weak global cues amid rising inflation and interest rate hikes have precipitated a huge sell-off in cryptocurrency markets. Now, investors and traders are questioning if the cryptocurrency markets will recover this year. Experts in the crypto business have differing opinions on this subject. While some analysts anticipate that cryptocurrency markets will recover from the present decline within the next few months, others feel that investor skepticism will linger in the near future. The relationship between cryptocurrency and financial markets is increasing. Cryptocurrencies have behaved similarly to the global financial markets, which have also been negatively affected by weak global cues. As inflation is expected to endure for the next 2 years, experts believe a looming economic downturn could continue to render crypto markets vulnerable. Given the strong correlation between the equities and cryptocurrency markets, macroeconomic headwinds such as decade-high inflation and rising commodity prices have a negative influence on the cryptocurrency market. The strong approach of the U.S. Federal Reserve toward quantitative tightening to manage inflation would exacerbate the downward trend in cryptocurrency prices. Since the U.S. money supply has grown at a rate of 18%, which is 3 times the rate of economic growth, inflation will persist for a few more years and is not temporary. To lower inflation while avoiding stagflation is a delicate balancing act for the Fed. If the Fed continues to raise interest rates, a recession will be approaching and equity and cryptocurrency markets would plummet. The crypto markets will remain volatile, and investor skepticism will prevail. The global inflation rate has been an important concern for investors. In the United States, the unemployment rate is at a 40-year high of 8.6%, and in the United Kingdom, it is at a 40-year high of 9%. As they reduce liquidity, interest rate increases in key crypto nations are also a significant worry. Both indicators have resulted in an enormous sell-off. In India, the central bank boosted the full-year prediction for the Consumer Price Index for FY23 to 6.7%, which exceeds the objective, and the Indian rupee has reached a record low of 78.28. As a result, investors have adopted a watchful approach because early indicators are negative. We anticipate this unfavorable market trend to continue in the foreseeable future. So do you think Bitcoin market has already bottomed out, or is the worst yet to come? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.